Welcome to Retirement Unpacked, a weekly podcast by Parallel Wealth. I'm Adam Bornn, and each week, along with our team of experienced financial planners, we'll explore the ins and outs of retirement, from income strategies to taxes, lifestyle choices, and everything in between. Before we dive in, a quick note. What we share here is for educational purposes only. It's not personal financial advice. Everyone's situation is unique, so be sure to talk to a qualified financial planner before making decisions about your retirement. Let's get started. Welcome to episode 10 of Retirement Unpacked. I'm Adam Bornn. I got Brett Martinson from our team here who manages our planners in our office here, and excited to get into this. As always, if you have questions, comments about this podcast or other financial planning, retirement planning topics, leave them below, whether you're watching on YouTube or listening on Spotify, Apple Podcast, or elsewhere. So, Brett, let's get into it here.
Yeah, absolutely. So question number one is around deferring OAS to focus on drawing down RRSP to save tax. So this is Donna Wilcox, 6436. I am 63 and retired at 55. I have government pension and took CPP at 60, which I now regret. Don't kick yourself for things you've done in the past. Just let's focus on the future. My husband also has a substantial LIF and collects CPP and OAS. LIF, Life Income Fund. We can't income split as we are in the same tax bracket. My problem is I have an RSP that I want to draw down and want to add it to my TFSA account, wondering whether I should defer my OAS while I focus on reducing RSP to save taxes. Would love some advice. Adam, what's your advice for Donna?
Obviously, old age security, you can start it as early as 65. Just give a bit of a background here. You delay it all the way up to 70. The benefit to defer your old age security is 0.6% per month, whereas your CPP would be 0.7, but she's already taken it. If deferring, really, this is where you need to sit down with your financial planner. Create two scenarios. One is not deferring your old age security and figuring out, can you draw down your RRIF account in a tax efficient way still, or are you going to be better off? That's how I would approach this. Obviously, if you're not working with a planner, you might need to hire one, or go to your financial institution and see what those different options are.
Yeah. And it also depends on how much is in the RSP or RRIF, if there's 25,000 versus 250. But in general, if you start your old age security at 65, you are almost certainly going to be slowing down your RSP RRIF meltdown. Whether that is a good or bad thing, again, can only be determined by looking into the details. But it would certainly be something I'd be reaching out to your advisor or planner about and just saying, look, can you run two scenarios on this so I can get an idea of what the pros and cons are?
Exactly.
So hope that helps, Donna. Next one. Analysis to support the use of a cash wedge. This is from Vic North 777. Have you guys actually done the analysis on the cash wedge? Having multiple years of expenses in cash is a major performance drag on the portfolio. I agree, and we'll get into that. Specifically, after the first 5 years of retirement, risk of ruin for a retirement plan is largely determined by the first 5 years. Yep. Having a giant cash wedge is a big performance drag thereafter. Is the cash wedge solely proposed as purely as a psychological safety blanket? I've yet to see any analysis that supports its use. Do you want to start, Adam, or me?
Yeah, so I'll just make a comment here. Analysis has been done, and actually, because we've had this discussion with Steady Hand, who employs kind of a cash wedge for their clients, and I thought they had done an in-house research. It was an out-of-house research, and he's getting that to me. He never got back to me quite in time, but there is research. The data actually supports there's not much of a difference from a financial standpoint. That's what the data shows. If you build a cash wedge or not, all things being equal. But the psychological side of it, right? So if things are equal, but building a cash wedge, you're not behind. Maybe you're not ahead, but you're not behind from a financial standpoint, but you're ahead from a planning psychological standpoint. The other thing with the cash wedge that it wasn't in this research, and I would say would be in no research I've seen, is having that cash wedge just brings that second peace of mind level of, it's taken care of. I know I'm going to get, because what happens in retirement is people get less aggressive, which is fine, but they peel back on their investments. Market, like in April 2nd, 2025 hits and people panic and sell. And because it's like, I need that money, right? Well, that's not built into the formula either. So the benefit with the cash wedge, I would say from a financial standpoint as well, is that you know your income's ready to be there, and it is ready to be there. So it avoids this, well, panic selling in and out, etc. So the cash wedge, the other thing too, most Canadians are invested in funds or ETFs. It's a pooled product. And when you have a pooled product, it's typically like a balance fund or a growth fund or something like that. Building the cash wedge just does separate out kind of the safety or the fixed income side of things to the more longer term equity side of things. So there's the psychological and the financial. Again, there's data out there showing the financial, all things being equal, maybe are actually pretty level. But the psychological side of it is a massive piece. And then, but that psychological piece scales back into or peels back into the financial piece of, shoot, I'm panicking and I'm going to sell something. Well, then the financial aspect of the cash wedge is miles ahead of not doing it.
Yeah. So I'm wondering if there's a little bit of confusion again around naming of things, that cash wedge does not necessarily mean keeping all that money in cash. So it would be a combination, depending on the timeline, of cash, GICs, bonds, certainly not things that are going to blow the roof off of your investments. Absolutely. But it's not all sitting there making 0.2% in your bank account or something like that. And if everything went perfectly, we wouldn't need a cash wedge, because you would be able to sell your investments at absolutely the right time to be able to withdraw that and spend that money, and you'd never sell on the downside or be freaked out by a downside or anything like that. So yes, the cash wedge is a psychological safety blanket. We all need one. Some people need 3 months want 3 months of a cash wedge. Some people want 5 years. And I would say if the plan can support it, this is not about racing to the end of the plan. It's, look, even if we did this on the conservative side of things, if we consider this conservative, and you can still reach your retirement goals, then great. If you decide to make a little bit more money with your money, fantastic. But if it can support the cash wedge and still reach your goals, then we're doing everything as I hesitate to say safely as possible, but we're doing everything, I guess I'll say, as safely as possible.
Well, exactly. And I think you make a good point there. Like, a cash wedge isn't necessarily your money sitting in cash. Like, our clients don't sit in cash. They sit in a fixed income that's fully liquid and not tied to market. So yeah, of course, if your money's, 3 years of income is sitting there earning $0 sitting on your mattress, that's not what we're talking about here. So good point there. So.
I'm also going to give a shout out to it's talking about research. So one of the top researchers in financial planning area is a gentleman by the name of Michael Kitts from the States. He's kind of like the States' Ben Felix to us in Canada. And he did a paper, I want to say it's 2018 or something like that, about this type of thing and the research on it as well. And if I remember that paper correctly, he said, here's the mathematical answer, but this mathematical answer has to be balanced with your client's needs, like what I always call sleep at night. So I hope that helps, Vic, but thanks for the question. Number 3 here.
One other, before we move on, sorry, Brett. One other guy that does great research is Don Ezra. And so if you search, and he's actually been on the Rational Reminder podcast as well, but he has a lot of information out there, a lot of research done around the cash wedge, about retirement. So if you're a real data person, like to see the numbers, Don Ezra is the name out there that's done some great research.
Yeah. You had me at, if you're a real data person. Number 3, you're speaking right to me, Adam. RRSP meltdown to TFSA in kind versus into cash first. This is Marty Menendez, number 1, or Marty Menendez 1, I should say, on the topic of a cash wedge for the person with a defined benefit pension. So I think this is referring to a question we had about 3 or 4 episodes ago. If the RRSP RRIF is being melted down and not being spent and reinvested into a TFSA, is there an advantage to turning it into cash first, or would it be better to move it out in kind? So we're going from RRSP RRIF to TFSA. How would withholding taxes work if there's no cash in the RRIF account, such as during such a transaction? So a few things there, Adam.
Yeah, I mean, you can convert if you're not spending that money, which a lot of our clients we're pulling from the RRIF. and using that $7,000 a year to top up the TFSA, you could transfer that in kind. That is doable. Just remember, there is likely withholding tax. So we have some clients though where they do it early in January, so it's kind of under that minimum RRIF amount, and moving that over. So yeah, absolutely, you can move stuff in kind if it's money that is longer term. But just remember two things: anything above what your TFSA limit is may not be going to your TFSA, and there is probably a withholding tax as well. So just remember that 7,000 over, they could be withholding 10, 20, 30% for withholding tax, depending on how much you're taking out time of year, etc.
Yeah. In-kind transfers is certainly possible there. So that's just moving. That's the point there being is that you're not out of the market. So I'm going to move my orange from, I used to use Apple, but Apple is an actual company. I'm going to move my orange from this shelf called the RRSP RRIF over to this shelf called TFSA. How the withholding taxes would work is really, I've seen it dependent on the financial institution. I've seen some financial institutions say, whatever we move over, we're going to sell a portion of that to pay the withholding taxes. Other financial institution, oh no, we've got a little bit of cash sitting here. We'll pay the withholding tax with the cash and just move the investment over. So you're going to have to check with your financial institution on that one. I'm willing to bet the vast majority of them are going to be the former, that they will sell some of it to pay the withholding tax. So you're not taking $7,000 out of your RRSP RRIF, as you're touching on, Adam. You're taking more out to get it over to the TFSA.
Yeah, and talk to your investment person to see what that looks like on your side, like have that conversation. So number 4, will tapering work hours negatively impact amount of CPP? This is from Fred Taylor, 5268. Unrelated to this video, but have not seen this covered on your others. I'm planning on deferring my CPP till 70. Well done. And working until that time out of necessity. But I'm looking to scale back my hours worked and therefore income earned. Will this negatively impact the amount of CPP I will collect at age 70? In other words, am I better off stop working at 65 while my annual work earnings are still high?
Yeah. I wouldn't use the word negatively impact it for a couple of reasons. One is, so if you made more between now and 70 versus making half of that amount, then yes, you're going to receive potentially you're going to receive less of a contribution post-retirement benefit, all that kind of crazy stuff to the CPP. But while we're working, I always tell people, so I'm going to start with the last point here. Am I better off stopping work around age 65 while my annual work earnings are still high? While we're working, 65, 67, whatever the age is, we are using somebody else's money for our spending, and B, not touching either any or we're touching the minimum amount of our own investments or our own assets. So working, to me, regardless of taxes, I can't think of a situation that puts less money in my pocket if I continue working. So if I wouldn't stop at 65 because I think I'm going to get more or less CPP. In fact, you'll get slightly more CPP because, again, that assuming you're not taking CPP at 65, you're deferring till 70, you're getting that post-retirement benefit and things like that.
Yeah. And again, Brett always says it depends. I say, go to the PWL calculator and put your information in there and it'll tell you what it looks like. So number 5, pros, cons of different types of health insurance. And this is from Scott Barlow 213, who's been a longtime follower. And I think Scott's asked this question on a few videos. So I wanted to touch on it in our podcast here, but we'd love to see you discuss the pros, cons, and available options and prices for those who are retiring early with respect to health and dental insurance. I know the short answer is to self-insure, but what are the available options and coverages, both private and government? So I won't get into all the government ones because every province and territory is a little bit different. In BC here where I'm at, we have Fair Pharmacare. So essentially based on your household income, once you've spent a certain amount, then Fair Pharmacare can kick in and actually help support you. So I want to touch on two things here. When you retire, if you have a health plan or looking to get a health plan, if you have something at work, then you can look at both Blue Cross and Manulife. Manulife is called Follow Me, but it's essentially if you're on a medication or have a health issue where if you went to apply for new coverage, maybe you would have some exclusions, etc. The Follow Me plan, say with Manulife, is actually, it continues on. Now you pay a bit higher, the coverage amounts are a bit lower, but if you're on a medication, it will continue to provide for that medication. So that's one option, is kind of the follow me. So when you're leaving, typically you have 60 days to trigger that or sign up for it. The other option is, maybe you've been retired for a while, or you've never had a plan, you're looking to get a plan. There are two big companies out there, obviously Blue Cross, Manulife. There's some other smaller insurers as well. But yeah, the standalone plans, what I always tell people, and we've done this analysis, or clients have done this analysis, and kind of come back to us and said, yep, it makes sense to self-insure. But what you want to look at is what typically do you spend in a year, and what would you actually be getting back based on what you're paying. So if you're paying, let's say for an individual, you're paying $200 per month. So $2,400 a year in premium. And then you look at the benefit and you're like, okay, well, I'm covered for dental up to 70%, up to $600 a year. And massages, I'm this. Am I this? Medication, I'm this. So just look at, well, in a typical year, here's how much I would use it. And then look how much is covered versus your premium. And again, you're paying $2,400 in premium. My guess is you're getting back $1,500 to $2,000. Maybe you're getting up to that $2,400, but most of the time you're not. We've had the odd occasion where a client says, yeah, this would actually be beneficial. Perfect. Sign up and work with the plan. But they can be quite expensive, but do that cost analysis. That's the easiest way. Whether you're doing the follow me, a new plan, any plan out there, just run a typical year. Here's what it looks like. Here's what I get for my premium.
Yeah. Yeah, exactly. And these are, so when I used to work at Sun Life, and they also have similar things, PHI personal health insurance and HCC health coverage choice, I think it was called. And same kind of thing is I would tell clients that there's a portion of this that, God forbid, something terrible happens, you could potentially get more money than you put into. That's the insurance part of it, travel insurance, or, out of country or something like that. But the other aspects of it, the dental and things like that, and again, this is going to be case by case, but in general, you're probably putting more or less the same amount of money in that you're getting out. If they're going to cover $300 of prescription eyewear a year, guess what? They've increased your premium cost by $300 divided by 12 because they know you're going to spend it. So I'm not suggesting don't get it. I have had clients in the past say, no, I understand the pros and cons, but I still want to get it anyways because I just want to know it's there. Okay, great. Sleep at night.
Yeah. A stop loss. Like if you have a big medication that you have to go on and it would be covered, and maybe you're covered up to 10 or 20,000 a year. Like there are benefits. Just be aware too, if you're on an expensive medication, I think I want to say every plan, but I would say almost every plan has a lifetime maximum. So again, sometimes, it's like, oh, well, I can, my work plan, I can actually continue into retirement. It sounds great, but you may have a $150,000 or $200,000 lifetime benefit. Yeah. And if you've worked there for 20, 30, 40 years, you may have dipped into a lot, if not all of that. So that's something else to be aware of on these. Now, if you're a corporation, even if you enter retirement, you have a corporation, one thing I would look at is a health spending account. That's what we use here at Parallel Wealth. So all of our employees have access to a health spending account. It's more of a pool of money. It's an expense to the company, but you're not kind of capped on, if I want to use my whole $1,000 at dental or all on massage, I can kind of use it wherever I want. So it's much more flexible. Again, it's only for people that are incorporated, and there's some rules around that too. But typically self-insuring, but again, run the numbers. Maybe it brings that peace of mind, right? So definitely something that's good to look at.
Yeah. Absolutely. Okay, where are we here? Number 6 here, I think we're. Yes. How can DIY investors make best use of professional retirement plan? Buy one. Contact us.
Yeah.
So I'm just getting accreting time to get to the right one. I think I'm out of order here, so I'll let you jump into there.
Yeah, David Black, 6413. Yeah, 3 questions for you. So he asked 3 questions. The first 2 we'd answered previous podcast, but the third one, how might DIY investors best make use of a professionally prepared retirement plan as part of their approach to retirement? So the reality is, and we have this conversation because a lot of our clients that hire us on the fee-for-service side are DIY investors, right? They're doing their own investments. They hire us to kind of create a plan, then they have to melt that down. And I actually had this conversation with a couple yesterday, and they're like, hey, this all makes sense, Adam, but now we have the plan. Like, how do we actually do this? And I said, well, that's kind of what you signed up for on the DIY side. Like, you need to figure out how you want to kind of create this drawdown or cash wedge or whatever you want to call it and structure it. That's part of DIY investing. And for a lot, DIY investing leading up to retirement might make sense for you. You might be comfortable investing your own money and doing your own thing. And at the end of the day, having money to save and going and buying a good stock or an investment is fun, and you watch it grow and whatever. But now when you're in the decumulation phase, it's a different beast. And so that's where we see a lot of DIY clients move out of DIY in retirement. Not that you need to, but part of like the question is, how can DIY investors make use? Well, we can give you a great plan. We can show exactly how to draw stuff down and where to draw it from and all the tax efficiency stuff. But the reality is, as far as like, well, how do I actually make sure 3 years of cash flow is put aside? That you've hired yourself as the investor. So you need to figure out how to do that. Now, again, we have a video series on this that will help kind of coach you through this a little bit. But again, every DIY investor looks a lot different as well.
Yeah. And certainly no dig at DIY investors when I say what I'm about to say, which is I don't think all do-it-yourself investors know all the things they're supposed to be doing it themselves. They, as you said, like I'm a do-it-yourself investor. I'm going to put money in. I'm going to pick the stocks, the bonds, the ETFs, all that kind of stuff. And if you're good at that and doing a great job, fantastic. But yes, there's all kinds of things about did something trigger capital gain that you weren't aware of, and all these types of things that you are signing up unknowingly as a DIY. And hey, I would say one of Canada's most famous DIY investors just recently retired, Rob Carrick from Globe and Mail, and there was an article on how he now has his money being managed by an investment manager and is having a plan done for him. I don't know exactly the decisions under that. It could have been the typical thing. Hey, I'm retired. I want to enjoy my retirement now, so I'm going to have somebody else handle this. How to best make use of a retirement plan? I would say working with clients at DIY, I hear a handful of things. One is, hey, this just gave me confirmation that I'm on the right track and that what I thought I should be doing, I'm doing, which is great. The other one is obviously, hey, this, I didn't realize this and I didn't realize that about the taxation and this thing and that thing. That now I know how much to pull out of my RRIFs and things like that. So in terms of how to best approach it, I can't speak for other financial planning firms and stuff like that. But, we do up the plan. We have conversations with the client. We have a presentation with the client, and there's a 3-month support period where they can reach out with questions about the plan. They can take it to their accountant, any part of their financial team. So I would say you're not alone in that question. And yeah. I certainly have seen a lot of value in it, but it's really up to the individual person to decide whether they're going to get value from it or not.
Yeah, the plan is a GPS roadmap for you. That's essentially what we're giving clients. And I always say, look, if you're a DIY investor and you can't actually implement it, that's a really good sign that maybe you should peel back from the DIY investing. And like you said, Rob Carrick, who I would say most of our listeners and viewers have read something from Rob's over the years. I think he was doing it for 35, 40 years. He was a big DIY, low cost ETF. Like that was his sermon every single week after week after week. Yet when he hit retirement, which is a totally different phase of life, he has transitioned out of that. And I'll maybe reach out to Rob, see if we can get him on and talk about that transition. Like what walked you through that process? Also, we'll get David Chilton on here in the next few weeks as well, hopefully. I'll talk to him about that because, he's a big DIY guy, obviously, as well, low cost. But I think if you're a DIY investor, you have a plan and you're sitting there saying, I don't know how to implement this. I think right there, that's a good trigger to say, well, maybe you should be hiring a professional to help you implement it then, right? Because it's a different beast altogether. So I think, David, just to answer your question, I would say, if you have a plan and you don't know how to implement it, then maybe you didn't just need to hire for a plan. You actually need to hire someone to actually walk through this with you too. So just a thought there. So on to the next one. Number 7, can you withdraw from a RRIF in the same year you converted? And this comes from, great handle. Love my poutine, 1846. I love my poutine as well. I'm gonna guess Love My Poutine is out of Quebec, because that's just the home of poutine. Anyway, great channel. I've learned so much watching your videos. Can you withdraw from the RRIF, Retirement Income Fund, in the same year you converted, or do you need to wait to the following year for the minimum to be calculated? Great question. We get it all the time.
Mm-hmm.
The quick and easy answer is yes, you can draw out of money from your RRIF in the year that you convert it. So it doesn't need to have a minimum max. Because it doesn't have a minimum amount, if you draw money out of your RRIF, there will be withholding tax from $1 that you pull out of that account. So just be aware of that. So that would be really the only difference, but you can pull out.
Yep.
The other thing to be aware of, if you convert to a RRIF and you transfer your money out, there typically the first year because there's no minimum, they won't withhold anything. And so this is with a RRIF at any time. And I'm bringing it up because a lot of clients that we're actually transitioning to our retirement income fund right now, or retirement income program, are bumping up against this, where if you transfer your RRIF from one institution to a next, whoever holds the RRIF right now will pay out the minimum amount before it gets moved over. So just be aware of that. So if you're transferring your money, early January, February, March, whatever it is, just a reminder that minimum amount will be paid out. But to the answer to the question for Love My Poutine, you can convert today and pull money out of your RRIF tomorrow.
Yeah, exactly. And the second part of that question too, do you have to wait for the following year for the minimum to be calculated? You do not have to wait for the following year to take money out. You do have to wait until the following year for the minimum to be calculated, because the minimum is calculated based on the balance as of January 1st. And that's why you don't have a minimum in the first year, because your balance on January 1st that year was zero. You didn't have a RRIF. So hopefully that is somewhat clear. If it isn't, just look it up in the Income Tax Act. They make it much more clear than
page
than we just did.
4,221.
Section
Permanent
83, number 1, 2.
Exactly. Permanent life insurance, which we get questions a lot. So permanent life insurance to cover taxes and as an investment vehicle. We get a lot of comments on this, so I've kind of lumped a few in here, but this is from John 97539. I'm 56, looking to get out of my term insurance. What are your thoughts on having permanent insurance as a means to cover the tax bill upon death, as well as investment vehicle? So kind of you're doing two things. Is this a good idea? Is it unnecessary? If it will probably have sufficient assets to cover any taxes. The insurance premiums would be solely paid out of my RRSP account. So this will draw this down. Can this be done without paying tax on the RSP? No, it can't. Anytime you pull money out of an RSP, you've got to pay tax on it. A permanent life insurance can make sense, typically more where you have a corporation, so you have money in the corporation. So again, for the death benefit, usually corporation, sometimes on the personal side as well. If you have a cottage, second home, rental properties, etc. Yeah, if you have any bill on death, a tax bill on death, then insurance could be a solution. And again, you want to run insurance, not do insurance. Like typically look at 2 to 4 different options on how to cover that tax bill. As far as using it as an investment, I would say traditionally no, unless again, you have a corporation with a lot of retained earnings that are sitting there earning money. You can actually put some of that retained earnings into the whole life or insurance policy and kind of shelter it and grow it tax deferred and potentially even tax free when you pull it out down the road. So insurance can be a very powerful tool in a company, in retirement, if you have extra money that you're never going to spend, or again, cottage, second property, that kind of thing.
Yeah. The way I'd look at this too is so first and foremost, to cover the tax bill upon death. Yes, it could be used for that. But my first thing I would be looking at is, can we get that tax bill down in a reasonable amount of time, better than just paying for insurance? I'm not against insurance. I think it's certainly got its place. I've just seen a lot of insurance sold improperly in this view of, oh, you're going to have a $500,000 tax bill projected on this plan in 30 years from now. So let's just sell you a big insurance policy. Yeah, but did you do any planning to try to get that tax bill down? And then in terms of using it as an investment vehicle, as you said, even on the personal side, I would always tell clients, if you have a lot of non-registered money that you're probably never going to touch, and you're looking to pass it along to the next generation, but still want to have access to it, God forbid you do need access down the road, permanent insurance can allow for that on the individual side. Doesn't have to be a corporation. Just know that when you do set up these plans, we're usually talking about 10 to 15 years before there's that break even of starting to pull the money pull the money out. So
Yeah, like
make
the
sure you
cash
just work
value
with
is
it.
equal to what you paid.
Exactly. Yeah. So
Yeah.
just make sure that you're working with a trusted insurance advisor on this, because unfortunately it is one of the major ways. The bigger the policy, the bigger the commission. And unfortunately,
and that's what people need. That's the insurance world, in my opinion, and I think a lot of people would agree with me. The way that the advisor is paid is through a commission. So like Brett said, the higher you pay a premium, the more commission is paid. It's not on complexity of the policy or how much time they put into it. It's just based on premium. So again, there's a lot of people listening and watching this that need this policy. They should reach out to our office and go through this process to save. We did a policy last year. The client saved millions and millions of dollars. And actually, he just reached out and he has a health issue now, and it's not looking good. So, I mean, you never know. But I would say most insurance policies are written or put in place by a pure insurance salesperson. So what Brett and I would say is, like, let's be planning focused. Like, let's drive everything from a plan, then see. Because I would say 99%, I would say 100% of our clients that come in to do a plan have a big tax bill at death. Absolutely. That's why they've hired us. But majority of them walk away with no tax bill. So that quote unquote insurance need has disappeared. And in fact, we've now put that back in their pocket. So yeah, just be aware of, have a planning first mentality, which ties us into what we saw this week. And what we saw this week comes out of Investment Executive, but it was all over the news. It's around Edward Jones. Most of you have heard of Edward Jones, large investment financial planning company in Canada. Edward Jones bets on financial planning. And so Edward Jones has adopted Conquest financial planning software. So they finally adopted a planning software. Brett, I'll let you dig into this.
Sure. So quickly, if on the Conquest side, it's a relatively new planning software, came out about 5 or 7 years ago, built pretty much by the same team that built another one 30-ish years ago. But we're not here to talk about the planning software necessarily. It's the fact that, and I had to ask Adam this, I said, and I felt a little stupid in that, are you telling me Edward Jones never had another financial planning software? Like, please tell me that they're converting from one software to another. So assuming that this means that Edward Jones never was using a financial planning software, then their clients weren't getting financial plans, plain and simple. They might have been getting some sort of quote unquote plan that was done on a spreadsheet or something like that. And that's how we did it back in the day. Sure. But that I think is what really piqued Adam and I interest on this. Even if they do have planning software, and again, I want to just stress that the name of a company doesn't necessarily mean whether you're going to get a good or bad service. It's the advisor you're working with, the planner you're working with, and I can only speak of my experience at Sun Life, and some of that experience was incredibly good. Actually, I would say the vast majority of it was. We had access to planners that we could bring in and do plans if we didn't have the time or the expertise to do it. We had access to planning software, but you didn't have to be a CFP to have access to that planning software. So I think the point, Adam, here, and I'll let you jump back in, is just don't assume. Unfortunately, I'm a little bit. I would love to speak with somebody at Edward Jones a little bit more about this and say, tell me what the story is here, because you're in 2025, you are getting excited about starting to do financial planning. So I'm not too sure. I'm just a little bit flabbergasted.
Yeah, it's like a surgeon coming out saying, "Hey, we're going to start using scalpels now." It's like, well, like what were you using before on me there, boss?
Yeah.
I think this is not an Edward Jones thing, obviously, either, and that's why I bring it up. I think there's a slow moving trend, and thank goodness, because we've been pushing it for years. There's a slow trend towards planning first, and that's this whole thing, right? Like Edward Jones is like, we're going to start building a culture where we do planning. I think that's hopefully, and it'll probably, big companies like Edward Jones will probably take decades to get there, but the nucleus of everything is driven from planning. Let's actually sit down with the client, build a plan, and then figure out, what types of investment do you need? Insurance? Do you need, to update your will, and all these other aspects of financial planning that we look at. Whereas right now, unfortunately, it's 99% of companies that are in our space You walk in, they sell you investments, and
Yep.
there may be no planning. Most of the time, there's no planning. And, I tell people on the phone all the time when we do strategy calls, they said, a lot of the time you're better getting no plan than the plan at, say, your bank, because the plan at the bank is, don't touch your money here, start taking your CPP, right? And people are like actually triggered to do the wrong thing. Whereas, they're watching our videos, hearing other stuff out there. It's like, okay, well, these other concepts actually make more sense. So yeah, I think it's a breath of fresh air to see some of these larger firms start transition to, let's actually be a planning driven. Not that Edward Jones is being planning driven, but at least you're doing financial planning now, hopefully.
Yeah.
Or at least you're going down that path. So hopefully you see a little bit more of that. So again, this is not an Edward Jones thing. This is a industry thing of, let's go again. You walk in somewhere, and this is where we do fee for service. We charge for the plan. Whereas a lot of people say, well, I can go get a free plan at the bank. It's like, well, yeah, it's worth the paper it's written on, right? It's just, you get what you pay for. So anyway, tip of the week. This is from Bill G, 5608. Question: what is the best thing to do if my wife and I receive a large inheritance, approximately $1 million in retirement? We're around 70 years of age, maxed out, and we've already converted our RRSPs to RRIF. And then Rusty Fender one. Great comment. It's like, adopt me. Yeah, I love that. So I'll let those two connect and see if there's an adoption papers happening there. But we see this a lot. So this is where I say, for a lot of Canadians, when they get an inheritance, if they get one, the best thing to do is to pass it down a generation, right? Inheritances at death should skip a generation. And so if in this case, if they get $1 million that, they're maxed out TFSA, their RSP, obviously they're drawing down at that point, it goes into non-registered investments. And that non-registered, it creates a tax bill for them. It's money, it sounds like they're never going to use, and potentially even climb back old age security. And so a lot of times, well, do you have kids or grandkids or charities or someone or something? Like, who are you going to leave this money to eventually anyway? And have that conversation of, can we actually start transitioning that now? And does that make sense? And would that help people out? So for a lot of people getting large inheritance, if you don't need it, or if you don't need all of it, it could actually become a tax burden for you, OAS clawback, etc. So yeah, really look to see, like, how can we transition this down and start creating generational wealth and helping the next generation?
Yeah, I would say the same in terms of, what would your plan be with that $1 million? And if the plan was, well, I'm probably not going to spend it, and it's going to become part of my estate and hand it off to the next generation, then maybe consider doing that now. Now, there's pros and cons to that. Speak with a family lawyer, accountant as well, potentially, but certainly family lawyer around, how can I give this money to my kids or whoever I want to give it to, but do you still want to have some sort of control over it? Do you want to make sure that it, or at least increase the possibility that it stays within your family? God forbid there's a relationship breakdown with one of your kids and their spouse or partner or whatever. So there are things there to consider around it. But in general, if it was going to go to the kids anyways, you might just be adding some taxes to the government, where they could be putting in their TFSA. Again, if you're willing to legally hand it over to them, you could be doing what's called a prescribed rate loan, where you're loaning it to them and allows you to have some restrictions on it while being relatively low cost for them, as well as it's a legal way of income splitting. So there's a few different options there. And I would certainly suggest passing it down or adopting Rusty Fender one, whatever you choose to do, pass it to your kids or adopt Rusty.
Yeah. We're not asking to be adopted, but Rusty's front of the line. So hit him up. Yeah.
Am I second in line, or are you second in line?
No, you can go second. Yeah, I'll go third.
Okay, perfect.
Yeah,
all right.
Perfect. Well, thank you everyone for joining us this week. Always great to go through this. Again, leave comments, questions below for us. We have a running list, and we're trying to get it to as many as we can, with also keeping this podcast in a relative time frame. So thanks for joining us. Thank you, Brett. Appreciate your time as always, and we'll see you in the next one.
No problem.
Thanks for joining us on this week's episode of Retirement Unpacked. If you found today's conversation helpful, don't forget to subscribe so you don't miss next week's episode. And remember, the ideas we talk about are general in nature. They may not fit your personal situation. Always consult a qualified financial planner before making decisions about your retirement. Take care, and we'll see you next week.